Welcome back to the Behind the Wells show. I'm your host, Roger Abel. I'm here with Elias Randel in the studio again. He has that same plaid shirt on. Is that the same one you wore the last time we filmed, Elias?
I think I got 4 in a row right now.
Is it the same shirt, or you like have a collection of identical plaid shirts for the show?
No, this is the same one.
Do you wash it though,
so
right?
I'm running. Yeah.
Okay, just making sure.
I just thought it'd be funny to keep wearing the same shirt until one of the listeners calls me out about it. So we'll see how many in a row I can go. Honestly,
I only recognized it because you told me you were going to keep wearing the same shirt. I don't really pay that much attention, but
you would have noticed.
You look good in that today. What's funny is you're not changing your shirt or shirt style, but I feel like the theme of some of the most recent episodes and shows is that a lot of stuff is changing and changing rapidly. And, you know, we worked in this show yesterday in this, actually, we talked about this stuff on WMT AM 600 last night. But there's a lot of change happening. And I just read an article yesterday, and I try to read a lot of articles and figure out why things are happening. I mean, why are we seeing the change? Why is technology ramping up so quickly? And I read an article that said U.S. household income in March surged 21%. On average, household incomes went up 21%.
Yeah. So that has a lot to do with some of the things we're seeing, right? Is incomes are higher right now.
I mean, I think you could poll 100 people, and every single person would tell you that they believe the prices of goods have gotten more expensive. I made a comment to my wife. Used to go to the grocery store, it's $200 a week. I'm buying the same stuff, and now it's like $250. Yeah. Either that or, you know, my girls are sneaking more stuff in. I don't know. I can't figure it out. But lumber, all-time high for lumber costs. So our friend Brad, who likes to do projects, he's like, I used to be able to buy a 8-foot 2x4 for $2.99. Now it's $8.
Yeah.
Gasoline.
Well, just like sheets of OSB are so expensive right now. I saw a funny internet meme where this guy had 2 sheets of OSB hanging out of his truck, and someone wrote, like, way to flaunt your wealth.
No, but it's true. I mean, I remember building shelves last year in a storage room in my house. I mean, it was cheap. Like, oh, yeah, it cost me like $30. Now I'm going to this. If I were to do it today, I'd actually probably compare the cost between buying a metal shelf that's like already built versus buying some wood and building a shelf, because arguably we're getting to be the same cost.
Yep.
Gas prices, those are going up. So inflation's kind of rearing its head. And Jerome Powell, Fed chair, actually had to talk about this at his last meeting and said he doesn't see this as a long-term, you know, inflationary situation, but a lot of it's supply chain related, still going back to COVID. My parents, they bought a new camper in January. The people that they bought the camper from said, had they put the order in February, they're not getting a camper because they ran out of glue for the ceiling. You can't find a used car. So there's a lot of things we haven't seen in a long time that are changing. And I can't help but to think some of it has to do with the amount of money that's been injected into the system, and the fact that, you know, when someone's income or household income rises 21%, well, all of a sudden they're willing to pay a little bit more to go buy the OSB versus when incomes were normalized.
Yeah. Yeah. And, you know, and people, it's, you know, owning a home or building a home, that's like something people are never going to want to stop doing. So, you know, the demand's high right now, and it might keep going for a while. It's, you know, I don't know that, but I would imagine it does. Most people I know either want to own a home or build a home at some point in their life. Well,
as we talk about, we don't predict. We just kind of look at what's going on in the world and try to figure out why it's happening, and are there ways to capitalize for clients. So it kind of leads me into the next article that I read. Actually, I had a client and friend. I'd call him a friend too, but we enjoy drinking bourbon and whiskey. And so he sent me this article. I thought this was really cool, and it relates a little bit to the finance world because it's actually from the collection of JP Morgan. And it's
which that's really cool.
It's really cool because JP Morgan, whether you like the bank or not, he's kind of an iconic figure in the finance world. But there's a bottle of bourbon that's set to hit auction, and they expect that the price at the auction, I think the auction's in June, to go for about $40,000. It's believed to be the oldest whiskey or bourbon ever produced, likely produced between 1763 and 1803. And in the way they kind of figured out how old that was, they went back and actually carbon dated it. So carbon dating, and I know this because I watched the Curse of Oak Island.
Yeah, see, I'm not familiar with carbon dating or how that works.
It's basically the ability. So in like Curse of Oak Island, they'll take like a piece of wood and they'll send it off to a lab and they'll say, well, based upon carbon dating, it is believed to be between these dates. And my wife just laughs at me because, these guys like never find anything. I've been watching this for 10 years, hoping they're going to find the treasure. I feel like I'm invested, but either way, it's pretty cool. And actually, so Jack Morgan is the son of J.P. Morgan, and he had given this bottle of whiskey to politician James Burns, and then giving the other 2 bottles to Franklin D. Roosevelt and Harry Truman sometime during their presidency between 1942 and 1944. So there's just some cool history with this, that it's one of 3 bottles, but I think it goes to we're seeing that excess of spending and people willing to spend money potentially on things that they wouldn't. And this is seen as probably more of a collectible versus I'm going to go pop this bottle and enjoy this with my friends. I mean,
this is a collector's item all the way.
200-year-old or 250-year-old bottle of bourbon. I mean, as cool as it sounds, not so sure I'm going to have a little drink of it.
Yeah, well, and for that price, I'd almost think I can't drink this.
Well,
it's too expensive.
It takes me back to, this must have been 3 or 4 years ago. My wife and I went to San Francisco for our anniversary, spent some time in wine country, but there's like a pier there, I don't remember what it's called, but there's a main drag in San Francisco, and there was a whiskey bar. It was really cool. You walk in, and it's literally like bottles of whiskey up on the wall everywhere, and from inexpensive stuff to the highest end stuff. And you're at a good whiskey bar when they're serving you square ice, but not like in a square mold. They're literally like cutting the ice.
They're chopping squares off.
Off a block. So
wow.
You're getting the real deal when you go there. And I was having a talk with the bartender, and I said, "Hey, what's the most expensive bottle you have?" And he pointed up to the top, and he goes, $30,000. I mean, whoa. And I go, well, how are you ever going to serve it? And he goes, because I asked it, once you open it, like, how long do you have to drink? And he goes, once we open that bottle, we pretty much need to drink it at one time. Like, he didn't believe it was a bottle they could sit back and just keep drinking from. So he said, I'm not sure it'll get open for a long time because I'm going to have someone that's willing to spend $30,000-ish to open that bottle and drink the whole thing with his friends or family or whatever it is. So
there's like a very limited amount of people who would do that and can't afford it.
You're right. And so the thing about this whole whiskey, it's kind of an iconic bottle because it's from J.P. Morgan. It's the oldest. It's actually not the most expensive bottle, though. I think the most expensive bottle is a little north of $2 million. I'd have to go back when I was doing some research. But so I thought that was kind of a cool way to kick this off. I'm going to thank Rob for sending me the article because I know he retired and he likes to drink the bourbon every day. So I have a little shout out for him. But
so it'll be interesting to see because they're set this price range and now this is getting publicity. Is it going to go for more than what they think at this point at the auction?
I mean, if you're so if you own a hedge fund or you're some big financier and you've got this iconic bottle that's believed to be from J.P. Morgan's,
I know there's got to be a handful of people that would really want it,
and money's really flowing. You might say, you know what, whatever, I'm going to spend what it takes to get this bottle.
This is going in my collection,
right? Because it's a collectible, which leads us to a really kind of neat thing I heard about. It would have been last Wednesday. I was listening to arguably our favorite podcast that we listen to.
Yep,
so shout out to The Compound and Animal Spirits with Josh Brown and Michael Batnick. But there's a new company out there called Collectable, and that's not with an I, it's with an A. And what Collectable does is they have brought mainstream collectibles to the average, everyday guy. And what I mean by that is I just saw the LeBron James rookie card sold for $5.6 million. And people that maybe aren't tuned into this, there is an absolute craze going on right now around playing cards, collectible cards. It is like nothing we've ever seen. Truth be told, it's what I thought was going to happen with my baseball card collection and my Beanie Baby collection.
Yep, back in the 90s, right?
I was driving to Lake of the Ozarks with a friend to go fish the Big Bass Bash down there. This is a couple weeks ago, and he was like, yeah, we were talking about this. He goes, I remember sitting around with my Beckett Sports magazine, right? And it's telling me the cost of the cards, and we'd be trading cards, trying to like take advantage of our friend, thinking this is going to be our retirement. And we're joking, but the only thing my Beanie Babies are good for is, we talked about it last night.
Well, if you really need to, you can insulate your walls. So,
yeah, so
Beanie Babies have some R value to them.
That was the best joke of the night. You said they had some R factor to them. I can insulate my walls with the Beanie Babies.
Yeah.
And according to the gentleman I asked about my baseball card collection, I might be better starting a campfire with it.
Yeah, what, $50 for the whole lot, he said?
And I mean, it's taken up $50 for the real estate in my garage at this point. But today's trading cards are different because in the 80s and 90s, the idea was we mass produce these things, crank them out, and that's how, we're going to, increase our market capitalization and be profitable. Where today they're really restricting the overall flow. But
they're focused on scarcity now.
Right. But what Collectible is, so just back to that bottle of bourbon, I'm not in the market for a $40,000 bottle of bourbon. Mm-hmm. I'm not in the market because I can't afford it for a $5.6 million LeBron James card or a $219,000 Patrick Mahomes or a Wayne Gretzky that just sold for $274,000. I'm not in the market because I can't afford it. It doesn't mean that I maybe wouldn't want to take part in it. So what Collectible has done is they have created a company where you can get fractional ownership of collectible items. They're primarily in the sports card arena. I went on and did a little research. I saw there's some Emmitt Smith trophies going out there. And really what happens is they set up, each card becomes its own entity, and then they sell shares. And it looks like most of the time the share price is like $10 a share. But what's kind of cool is if I wanted to own part of that LeBron James card and they had the ability to offer shares, I could buy part of that.
Yeah. And I love this idea. For me personally, I'm not really a collector, but I mean, to have the opportunity to own a little bit of something really cool like that, like I think that's something I would be interested in. And I really have no desire to collect cards or jerseys or anything like that.
Yeah, I don't either. I don't have that desire to do that, but I do think it's cool because collectibles for the most part have been for the ultra wealthy. I think back to growing up, like
True.
You had the Ty Cobb card, you had the Honus Wagner card, you had the Mickey Mantle, like the creme de la creme of these cards that were believed they were super valuable. Well, they've never been in my reach, right? And now they're getting more expensive. They're still not in my reach.
Yeah.
But now with Collectible, it is. And here's a flip side to what Collectible does. Let's say I was fortunate enough to have the money to buy that LeBron James card. Well, I might want to take some chips off the table, right?
Yeah, right.
So what Collectible will do is actually let you sell shares in your card. So I could still retain ownership, 50% ownership, but sell shares for the other 50%. So I think it's a really cool idea that allows people the opportunity to kind of open up an asset class that wasn't available to them before, strictly for the wealthy. It's almost kind of like what Robinhood's done with investing. They're kind of decentralizing it. Robinhood has fractional share ownership.
Yeah.
PayPal, you can get fractional share ownership of Bitcoin. Well, it's a lot easier to buy Bitcoin when you can buy $100 worth versus $55,000 worth.
Yes.
Not saying either one of those are good investments. It's just made it easier to access. And it goes back to incomes are rising. People have money to buy collectibles or invest in things. We're making it easier to invest. So I think that's part of the change that we're really seeing around a lot of this stuff.
Yeah, and it'll be interesting to see, like with the Collectible, as they start to be a more popular company, like is there going to be speculative trading on these fractional ownership of cards? Like someone goes out and buys 5 shares for $10 a share, and then they turn around and sell it to the next guy for $12 a share.
And they can. So they have a daily, and I haven't researched all of it because I hadn't bought it, but they have a liquidity feature. So I could buy it and then sell it at current marking price. I know there is a lockup before you can get your money out. I think it's like 90 days. So they're not making it so you can day trade it because they probably don't want that much volatility, but it's a new cool idea. And the person I'm going to ask is, I have a friend in Louisiana, and he's way into cards. He flew to New Jersey the night before the Super Bowl to buy a Tom Brady rookie card.
Yeah, he'd be the guy to ask about this.
And I'm going there in June, so I'm going to find out and say, hey, what do you think about this? Because, obviously there's some fees and expenses to do business with the company. I don't know what those are, but I'm going to see what he thinks about this idea because he has a massive collection. Who knows, maybe he's actually using it, but I think we'll have a follow-up kind of on that.
Okay, Roger, so that's a good segue into kind of one of the articles I wanted to bring up. I came across one called the Delusions of Crowds. The Delusions of Crowds and Why People Go Mad in Groups. So the article I read was kind of just a summary of a new book that came out by a guy named William Bernstein. So he's wrote some finance books, and his latest one is kind of around what's going on right now. So in the last year, we've seen a rise in retail investors coming into the market with, things like Robinhood because you have access to trades without commission. In cryptocurrency, there's people getting into that. And like we're talking about, people are making more money now, so there's more money available to do these things. And here were some of my takeaways from this book is, so speculation and kind of like following the herd or the crowd. One, this is not a new idea. There's actually a book from 1841. It was called The Memoirs of Extraordinary Popular Delusions and the Madness of Crowds. A guy named Charles Mackey wrote it, and it was about things we've talked about before, like some stock market bubbles in the European markets back in the day, tulip mania from Holland, way back in the 1800s. And Bernstein's he summarizes everything by saying, well, there's kind of four key indicators of when this really, this crowd mentality kicks in. And it's one that financial speculation starts to dominate all conversations. So small talk is not of like family vacations and weather and stuff like that, but more around today it'd be like, people speculating on NFTs or Bitcoin or whatever it is, trading on Robinhood.
That's a good example. So my home builder who built my house 4 years ago called me up just to shoot the breeze. He's like, usually if he calls me for something, he's got a question like, can you help me here, do this for me, whatever. Not a client. Just calls me up out of the blue. Hey, what do you think about this? And what do you think about this? And I just started thinking, like, you don't know anything about this stuff. 4 years ago, you were asking me what the fiduciary rule was and if the mutual funds you owned were the right ones to own. But now you're speculating in day trading. It's like, yeah, the account goes up and down, and he's buying all kinds of different stuff. And I just thought about him like, where have we gotten to? And I come back to 2021's greatest line. Successful investors don't act that way. Yep. And I told him that. I said, I use that exact line.
That's going to be the line of the year.
That's the line of the year.
It's going to come. And
full disclosure, I stole it from Josh Brown. You stole it from Josh Brown. But it's a line of the year. Successful investors don't act that way. And I straight up told him that. And he goes, yeah, you're probably right. That's what he said to me. So, but that's to your point, when all of a sudden you're getting financial advice from your roofer or the gardener or the guy at the local barista sitting behind serving you your grande latte in the morning.
Yeah, and for my situation, my brother, he's called me about individual stocks, and I know he doesn't know anything about finance. Well, and it was like a Wall Street bets. Well, hey, everyone's saying this one's going to go up.
I got a call from a client the other day. Hey, have you ever heard of this? So I Google it, and it's foreign exchange trading. I'm like, okay, my granddaughter thinks this is really cool. I go, wait a minute, your granddaughter, what does she know about foreign exchange currency trading?
Yeah.
Well, she follows some board on Reddit and she thinks it's really cool. How do we tell her that this isn't a good idea? And my response was, well, you can't really tell her it's a bad idea because then she's really not going to listen. It's probably more of a conversation around explain to me how this works. And if you can't explain to me how it really works, then we probably shouldn't do it, right? Just following a board doesn't make a good decision. You're going to talk about that later. I don't want to steal your thunder, but
yeah.
I just thought about those examples. It's starting to dominate conversation with everybody.
Yeah.
And we saw this in 2000, right? All going to be day traders, the tech bubble. We're not saying there's a bubble. Maybe this is here to stay. Maybe we're going to have this lasting effect of people really being interested in investing or speculating. I don't know. Maybe it's here for a long time. I don't want to speculate or make a prediction, but your point is interesting.
Yeah, and I think we both agree. It is great that people want to come into the market. It's a great place that everyone has access to build wealth over the long term if you're using the right behaviors and analyzing the situations correctly. But it's kind of like a double-edged sword, right? Because there are some aspects of the stock market that are almost like casino. It is so accessible. You do have the ability to day trade. So I think that's that's the issue is it shouldn't be something that's gamified or made into a casino, because that's not, kind of everyone sharing in the prosperity. That's not the point, or that is the point of the stock market. It's really not, it shouldn't be seen as a get-rich-quick vehicle.
Usually when it's seen that way, some will get rich, right? And
yeah, some people make
some
money.
people are going to get rich. Most won't.
Yeah.
I mean, if it was that easy, we'd all be doing it.
Well, and for the younger people, if you're listening or doing it, hopefully you learn your lessons earlier on in the process when the money's really not that meaningful.
Right.
You're not doing amounts that are actually going to affect your life. So just kind of wrap up, his other three points about that were sensible professionals will quit reliable jobs to speculate. There's probably a little bit of that. I think you know someone, or you mentioned someone who was going to start trading stocks and crypto.
I had lunch with a friend on Monday, and he's asking me about all this stuff. He called me up and said, hey, have lunch with me. We had some restricted stock units he wanted to talk about with his family, what he should do. But then he said, what do you think about this asset class and this? And, oh, by the way, I have a friend who's going to leave his job, and this is what he's going to do full time. Reminds me of 20 years ago. And when all of a sudden you're leaving your engineering job because you think you're going to be a trader, that's exactly what this means when sensible professionals quit their good job because they're going to trade. He's probably going to go back, more than likely, to that good job at some point in time. And I hope he doesn't. I mean, it's one thing if it's a hobby, but we make this comment. Everything goes up. Yeah, it's hard to not make money, but it doesn't go up forever. Doesn't mean that over time it won't go up, right? We take a long-term view and believe long-term prices will be higher in the future, which will cause the stock market and all these other asset classes to go up. But the rapid pace things are going up right now won't last forever.
Yeah, well, and you've told me before, there was a narrative 20 years ago that everyone is going to be so good at day trading that financial advisors would be out of business.
We'd be out of business. And you know what, though? Our industry has changed dramatically from 20 years ago.
Yeah.
Because 20 years ago, we were seen as stock pickers. Today, I don't know too many people calling up a client saying, hey, this is the next hot stock. Because that's not what really helps people. What really helps people is building a financial plan to quantify where they are now and where they're going. And that's what our job has 100% morphed into.
Yeah, the job is morphed into, financial planning as opposed to stock picking.
Correct.
Yeah. And then another point he made, so skepticism is met with anger. So this is like if you have a conversation with someone about Bitcoin, it'd be exactly like and we're going to talk about Warren Buffett and Berkshire Hathaway's annual meeting. Well, they gave an opinion on Bitcoin that it's an asset that does not produce anything, and which is a true statement. That's a fact. It doesn't actually produce anything. It's all price speculation. And, and then people, they're upset with that because they don't, it's a fact, but it doesn't go along with their narrative. So then they get angry about that. And the other thing, and this was a very good point, so then observers begin to make outlandish financial forecasts. And I think recently we read a forecast on Bitcoin predicting like a 27,000.
It wasn't Bitcoin.
What was it?
I was on Facebook yesterday, and it was an ad. I'm trying to find it. It It was by Cointelegraph.com, had an ad, and here's the headline. Altcoins just repeated a move that could launch them 27,000% higher in 2021. So 27,000%. And this isn't our prediction. This is an actual ad that I saw on Facebook yesterday before we went into the show. And where are they getting this number from? I mean, yeah, boy, I wish I could start a website and say, hey, I think it's going up 27,000%.
Yeah.
I mean, do you know what our broker dealer would say if that was the ad that we put on Facebook? It's not, I'm not saying it can't happen. I'm saying it's highly unlikely, and it's outlandish speculation.
Yeah, and it's just, and these ideas, these are the things that happen when these bubbles start to occur. And is it going to unwind? No one really knows. It could not.
Well, here's the point.
And I'm not anti like crypto in the future. Like, there's absolutely things I think will always be part of our lives. Personally, I'm not going to price speculate on those things.
Well, if I knew it was going to happen, I would make the right move.
Right.
I mean, it'd be that simple. I'd make the right move for myself. I'd make that move for my clients. I mean, it'd be really simple. It's not that simple because in all these asset classes that are, increasing in value really, really quickly, there's two outcomes. You're going to be right or you're going to be wrong. And I don't know which one we're going to be, right?
Right.
But what I know is if I have a well-crafted plan that says this is what I need to do to be successful, and I stick to that plan, my outcome's good. In fact, you maybe came up with the best parallel for this. And I'll introduce and let you talk about it, but Bill Miller in our industry ran the Legg Mason Value Trust for 15 years. He's famous for outperforming the S&P 500 for 15 straight years. I mean, he was a legend until 2008 and 2009. Yeah.
And he basically made like two bad moves in his career and then just got, and then people just took him to the woodshed over it. He got hammered on about this, and his funds suffered and his personal net worth suffered a lot, but he's a billionaire now. And 12 years later, 13 years later, he's a billionaire. And, like you said before, he stuck to a plan, and not only stuck to it, but he believed in his plan too. So it's almost like a little bit of aspect of, and when people are doing financial planning, it's like you either believe or you don't. We can provide all the facts. We can provide, whatever the stories and the narrative to help people make decisions. But at the end of the day, it's like you either believe it's going to work out and you're going to do the right things, or you don't believe, and maybe you're going to chase something or speculate on things that may or may not work.
So, Elias, your point of Bill Miller, and I think the good analogy is Bill stuck to his guns. He did what he knew he could do to be successful. He made a bad move in 2008 and 2009 and actually started buying some toxic assets in the financial crisis. He was looking for an opportunistic time. He didn't believe Bear Stearns was going to go under, Lehman Brothers would go under, AIG would take bailout. He didn't believe any of that because it's not what got him there. And there's a mutual fund company that kind of suffered not the same plight of this, right? But for years, they were creme de la creme. I'm not going to say who it is, but they were huge holders of Fannie Mae and Freddie Mac, so their funds suffered more than others. And people that had been loyal to this company for years jumped off the bandwagon.
Yeah.
And guess what?
That's a blip on their radar now in the history of their performance.
And guess what? They're back.
Yeah.
With force. And so I just think about that in your analogy of saying, hey, stick to the plan and stick to what you can execute. There's going to be bad stuff that happens. I mean, it's not like this great roller coaster where you just go up and up and up, right? It's a roller coaster. It's going to go down. It's going to go up. It's all how you handle the adversity in your financial life will determine your outcome. I go back to the worst investor ever, that little exercise we ran. Timing doesn't matter. What matters is time in the market.
Yep. Yeah. And, and Warren at the Berkshire Hathaway annual meeting, Warren Buffett and Charlie Munger, they made great points about time in the market and stock picking. And they actually had his point, he was asked a question, and it was kind of around, okay, with the rise of Robinhood and commission-free trading, what are some of your thoughts on that? And of course, Warren Buffett was prepared. He knows what questions he's going to get asked, so he's got 3 slides ready to go. And I'm really glad someone asked this, because I have a lesson for younger investors that are listening. So he showed a slide that was the 20 biggest stocks in 1989. And then he showed a slide of the 20 biggest stocks currently in 2021. And the 20 from 1989 are not the top 20 biggest companies in the world anymore. So they're totally different. And the point he was getting at is the world can change, and it does change in dramatic ways. And picking individual companies for the long term, which he's been very successful at, is hard to do. And the other example he brought up, and I thought was very fascinating, was kind of at the height of auto manufacturing. We had over 2,000 companies making cars in America at one time, and now, what do we have? 3 auto manufacturers, maybe 4?
Somewhere in there, but here's what I take away from that. So the top 20 list, it doesn't mean that those 20 companies by market capitalization from 2000 or from 1989, they're no longer in existence. It just means they're not the biggest. But some of the companies on there was Exxon, ConocoPhillips, General Electric. Who'd have thought General Electric wouldn't be on there? Merck was on there. So fast forward to today, the largest companies on there's, Apple, Amazon, all the companies we think of.
Facebook.
What that means in 20 years, if history repeats itself, in 20 years, none of the companies today may be on that list. Think about that. Well, who would think that in 20 years, Apple or Amazon or whatever company it's going to be won't be one of the largest top 20 companies? And we should actually have this as a definitive point in time, because I plan on being here in 20 years.
Yeah.
Hey, in 20 years, let's look back and say, hey, are these still the top 20 companies? And if they're not, what that really means is that, like you said, it's really hard to pick an individual company for the long term that's still going to be one of the top growth and top, producing companies.
Yeah.
And it goes to why, for most investors, trying to get on the Robinhood app and buy a fractional share of Amazon probably isn't the way to get rich. The way to get rich is have a systematic savings plan, all the boring plaid planner financial stuff that's out there, right? Systematic savings plan, do a financial plan, have a well-diversified portfolio, which if you think about Berkshire Hathaway, to go back to Warren Buffett, they're almost like a mutual fund. If you think about what they do, is they're a conglomerate of companies. They go and buy companies, and that's what they do. Where like Amazon produces or sells goods and services through the internet. Apple produces phones and technology. Berkshire Hathaway, they don't really produce anything. They produce returns for people through the acquisition of different companies. They're like a big conglomerate. So they are actually more like a diversified investment portfolio than that of an individual company.
And here's one of the things I get a kick out of is it's almost a little bit cool now to okay boomer Warren Buffett. And he's been successful for a reason. So, is he 90 some years old? Yes, he is. But the wisdom and the things he knows about investing and evaluating businesses, there's value to that. It's not like he's not out when he says stuff like, I think it's immoral to gamify investing. He's not out of touch with reality. He has a very good sense of what's going on and the reality of the situation.
Yeah, and Robinhood hit back at him and said, why are we still listening to these old guys? Well, I don't know, because they've been the greatest investor of all time. Maybe that's why we listen to them. So with that said, it was a great show, Elias. I had a lot of fun doing this. The world is changing around us. We're not going to change. We're going to stick with the plaid planner.
We're too stubborn to change.
We're too stubborn to change. We're going to stick to our plan. With that said, if anybody's looking for help with their overall investment portfolio or financial plan, you can get us at btwellshow.com.